Hey, Marty James here, driving down the road. Just had some ideas I kind of want to share with you. I was thinking about, hey, we're approaching the end of 2020, in a pretty rapid pace here. Things seem to get, they say the older you get, life's like a roll of toilet paper. The closer you get to the end, the quicker it goes. So that's kind of how this year feels, and soon it'll be in the rearview mirror. So I was kind of thinking about 2021 and specifically, your 401k contributions. So most plans now have, the Roth 401k, which, is a really good option. And some plans actually have some other features in it that we call in-plan Roth conversions. Some plans, a lot of plans don't, but, if you're a small business owner, it's something you can easily add to your plan. Just contact your plan administrator, third-party plan administrator, and have them, update your document to allow for this provision. Or if you work for a smaller company, you just might want to mention this to the owner. It's a pretty powerful tool. So, the question is, should I do Roth or should I do traditional? And it's really a tax bracket management question. So, the fact is, if I put money in my traditional 401k, I'm getting a current, income tax deduction, which, the term income tax deduction sounds very, very appealing, but in this situation, this is, it's an income tax deduction, but it's really a loan from the government. Eventually, they're going to want their money back, plus their share of the earnings on that money that they loaned you to invest. So the money in your 401k, traditional money, is not all yours. The government has a claim on that. They're participating in the upside and the downside of your 401k. So when the market goes down, they lose a little money too. So just let them know they should be feeling the pain right along with you. With that being said, the first thing that you're going to look at going into 2021 is, what's my marginal tax bracket? What's that next dollar that I earn? Now, marginal tax bracket is a different number than your effective tax bracket. We have a progressive tax system, so as I earn more money, that money goes through the various tax brackets and, starts at being taxed, very, very low and gradually gets, higher and higher. So I'm really focused here on that current marginal tax bracket. What's my next dollar? So let's say I'm in a 24% bracket, but if I put money into my traditional 401k, it brings me right down into the 22% bracket. So I have no money, none of my dollars are being taxed at a current rate of 24%. My last dollars are being taxed at 22. So, that's a really important concept to understand. So when making the initial decision on the Roth versus 401k is, do I think taxes are going to be higher when I take the money out in the future? Or maybe taxes aren't higher, but will my tax bracket be higher or lower at that point in time? If my tax rate's going to be higher, or if I believe tax rates are going to be higher, then I'm probably going to want to lean towards the Roth 401k contributions. On the flip side, if I think I'm making more money now that is being taxed at that higher rate, and when I get into retirement my tax bracket's going to be lower, well then maybe I want to favor doing the traditional 401k. So that's kind of your starting point. And let's say I'm in the 24% bracket, but I'm only $10,000 into it. So the last $10,000 I earned was in the 24% bracket. If I, put into my 401k traditional $10,000, now my last dollar was taxed at 22%. I pretty much maximized that 22% bracket at that time. But let's say that I'm only $5,000 in the 24% bracket. Well, what if I did both? What if I did $5,000 in my traditional 401k and $5,000 in my Roth 401k? Essentially what I'm doing is I'm taking that $5,000 and reducing my income so that none of it's being taxed at 24% and it's all 22%. I'm just bracket managing here is what I'm doing. So, those are some things to look at. We can help you with those calculations and such. One of the things you might want to look at is when you're making your whether to do the Roth or not. ADP's got a pretty good payroll check calculator out there, so you can see what the difference is. It's pretty, fairly simple to use. So you can see how much it changes, which that brings me to the next point for you people who do have the in-plan conversion. So here's a strategy that I think could possibly work well for you, but you have to pay attention throughout the year what's going on with your 401k balance. So for some people you may not do it because you don't pay that close attention to it. The idea is I start off the year with a tax deductible pre-tax 401k contribution. Now when I do this, my check actually doesn't go down as much as it does when I fund my Roth because of that loan the government's given me. So what I would do, and like I said, you can go back to this ADP calculator and kind of see what that's going to look like. So let's say, I'm an accountant, not a mathematician, so I'm going to make the math really easy here. So I'm going to put, $10,000 in. I'm in a 50% bracket. The government loans me $5,000 this year in current income tax deduction, which again, sounds really, really great. Most of us take that money and we actually spend it. But what I'm recommending is you set that money aside. The difference between your Roth 401k paycheck and a traditional 401k paycheck. So I set that aside. And this strategy will work if you really want to be doing Roth ultimately anyway by the end of the year, or if you can't, if you're just waiting for an opportunity to do some conversions. So now the government has loaned me $5,000, and I now have $10,000 into my 401k plan, but $5,000 of that right now actually belongs to the government, and they're going to want their money eventually. So let's say the market goes down 50%. So now my account balance and the government's account balance combined is worth $5,000. Now remember, the government has loaned me $5,000. So at this point, in this account I have $2,500, and the federal government has $2,500. So let's say I do my in-plan conversion. Now I'm going to pick up income taxes currently on $5,000 of that converted amount, but at a 50% rate, that's $2,500. So what just happened was the government loaned me $5,000. Okay, I took their $2,500 of their $5,000 and paid them off. That other $2,500 is mine to keep forever. So now my 401k balance in the Roth balance is $5,000, and as the markets recover and such, 100% of that earnings is mine, and the government has no claim to any of that money going forward. So this is a strategy that I think would really work. Now let's say during the year, I'd already decided I really wanted to be doing a Roth, and during the year nothing happens in the market. It's just kind of steady Eddie, no major corrections. I don't have to have a 50% correction to make this work. But say it just gradually hangs in there, kind of goes up normal type returns, so by the end of the year, I just go ahead and convert the amount that I fully intended to contribute to my Roth 401k anyway. So the only downside to this is the market is on a rip-roaring rally, kind of like we've seen here recently, and that continues throughout the whole year. Yeah, I just created some more tax-deferred earnings in my 401k, but maybe I'll get an opportunity later to actually convert some of those dollars. So that's kind of the strategy. Give me a call or drop me an email. Want to discuss it a little bit more, but look at your plan provisions and see what's out there. So I'll probably put together something that's a little better as far as